Hey guys, welcome back to another episode of Diamond Dividends, where I go over different dividend stocks and ETFs and I break down 5 of the most important metrics that really emphasize how much of a long-term position they may be, even with a low budget. This series is one that's very important to me, especially as someone that doesn't necessarily invest a lot in comparison to a lot of other people on this platform. But I hope to use this as a motivational tactic for you guys out there that may feel like you don't have enough money to make a difference, by showing you that you do, as long as you're looking at the right things to hopefully make the right decisions. But anyway, for this episode, we're gonna go over one of my favorite monthly dividend paying positions, and that's Main Street Capital. So Main Street Capital is a BDC, or a business development company, that focuses on lower to middle market companies. They provide debt and equity financing earnings through interest and fees from debt instruments and equity gains and management fees from fund instruments. This is pretty cool because they're providing funds from small to mid-class businesses that can't easily get funds from banks, and then those companies have to pay a high interest to pay back Main Street Capital, which is how they make the money to pay us in dividends. On top of that, the equity gains means that Main Street Capital has a stake in whatever company that they hold. So if that company gets more profitable or it sells for a profit, then Main Street Capital gets a chunk of that money. Now, the BDC status of Main Street Capital is really important when it comes to how much it actually pays in dividends, but we're going to get into that later. In the meantime, we're going to focus on metric number 1 of the 5, and that is earnings per share. Your earnings per share is going to be your total net income minus the preferred dividends, all divided by the number of outstanding shares or available shares in the market. EPS shows business profitability and growth potential. So as a long-term dividend investor, especially as someone that doesn't invest a lot, you want to see an EPS either stay stagnant or ideally increase over the long term. Now, for Main Street Capital, the past 10 years show their EPS went from $2.31 to $5.85, resulting in a CAGR, or compound annual growth rate, of around 9.74%. The CAGR part just means that every year from 2014 to 2024, their earnings per share had to increase by almost 10% to get to where it was back then to where it was as of last year. But anyway, this is a great sign for consistent growth, being able to pay off their debts, and being able to consistently pay and increase their dividends to shareholders over a period of time. That's really important. When you look at a chart on Seeking Alpha or Robinhood or any brokerage app, the change in its share price over time is typically their price return. The total return, however, is that, but it also accounts for the dividends that it pays that get reinvested back into the share price. So ideally, you would want to see the total return over a period of time be higher than a price return over the same period of time. Doesn't necessarily matter how much higher, but you want to see it be higher. Now, Seeking Alpha only shows me the past 5 years because I don't have a membership with them yet, but for Main Street Capital, it shows that their price return is almost 100%, which is awesome. But what's even better is that if you reinvested the dividends over the same period of time, you'd be looking at a total return of 188%, almost 90% more. That gives Main a total return CAGR of 15.26% per year. Total return and total return CAGR might be my favorite investing metric because I really feel like it paints a full picture of how valuable a stock is, no matter how much you have to invest. The share price growth, or the price return, shows that whatever the company is meant to do is working and they're making money. And the total return growth being consistently higher shows me that they can consistently pay and increase their dividend payout. And that's really impressive for a company that is meant to pay 90% of their net income to shareholders in the form of dividends to maintain their BDC status. Debt to free cash flow tells you how many years it would take a company to pay off its total debt simply by using its free cash flow, or the amount of money it has left after expenses and reinvestments. Typically, a healthy ratio would be between 1 to 2, 3 to 4 is fairly moderate, and then 5 to 6 or anything higher is going to be a little bit risky. There's a concern that they're going to have some issues in the long term. For me, I use, yet again, Seeking Alpha to calculate the debt to free cash flow ratio, but it doesn't actually have a specific metric with that name. You have to look up 2 different things. One's the levered free cash flow, which is under the cash flow section. That's the free cash flow left after a company pays its financial obligations. And then you get the total debt from the balance sheet section. And I also use ChatGPT to make those calculations because I was feeling a little lazy, but this is what I got. Over the past 5 years, it's been trending down from 12.26 times to 8.87 times, meaning it would take 4 less years now to pay off their debt than it would back in 2020. Now, besides the spike spike they had in 2021, more than likely caused by the effects of the pandemic. The fact that it's decreasing shows that they have more control over paying off their debt, which is really important, especially because this is assuming that they're not getting any more income. They're only focusing on their free cash flow. So if you see a nice decrease over the debt to the free cash flow ratio, that's a pretty good sign of a long-term hold. So the dividend yield, that's going to be one of the first things that most investors of passive income are going to look at. But the one thing that's more important than the yield itself is the yield history. The dividend yield CAGR is going to take into an account the year-over-year changes of that yield, so it factors in the spikes up and even the dips below. And of course, you want to make sure that the dividend yield history is at worst stagnant, ideally increasing. Now, Main Street Capital currently has a dividend yield of 6.97%, meaning it pays $4.26 per year per share. But what's really great is that its dividend has grown over the past 17 years, and it has a 5-year growth rate of 3.84%. Now, its 3, 5, and 10-year CAGR is 5.42%, 3.84%, and 3.83% respectively. Not super high, but considering that ideally the rate of inflation is 2% every single year, having a dividend CAGR of 4%, since it's higher, is pretty good. Plus, since December of 2021, Main Street Capital has been paying a once per quarter special dividend, adding an extra amount of money to everyone's pockets. So aside from getting an increasing dividend amount every single year, an increasing yield means that the amount of money you're getting in return will increase as you continue to invest into the position. Plus, although kind of lowish, a 4% dividend CAGR is going to suggest some sustainable growth rather than a one-time spike. The last metric is the payout ratio, which you can find by taking the dividends per share and dividing it by the earnings per share. The payout ratio is actually a percentage, and it's the percentage of a company's net profit that they give out as dividends to shareholders. And according to Investopedia.com, a healthy payout ratio is going to be between 40 to 60%. Now, Main's current PO ratio is 72.77%, which is a lot higher than that range. However, this high ratio is showing that they're covering their dividends from real profits, which is a really good sign for stability. Now, this is the kind of confusing part, or at least it was for me at the beginning, but as a BDC or a business development company, yet again, Main Street Capital is supposed to pay 90% of its income in the form of dividends. That's because the payout ratio uses net income, or EPS, while the 90% rule uses taxable income, which can be totally different. So just because the payout ratio is below 90% doesn't mean Main Street Capital is falling short. It just means that it's keeping its dividends sustainable based on its actual earnings. And again, that's a great thing. Now, what does this all mean when it comes to investing a small amount over a long period of time? Now, what I like to do in this series is actually take my own investing situation and apply it to see how much money I can actually make over the next 5 to 10 to 15 years. So with that being said, here is the potential growth that Main Street Capital could have over the past 10 years when it comes to dividends and over share price growth, all with investing only $30 per week. In 5 years, you can start generating $337 per year in dividends and have a balance of almost $9,000. In 10 years, you'd be looking at $765 per year in dividends and a balance of over $26,000. And then in 15 years, you could possibly be making $1,276 per year in passive income and have a balance of a little over $55,000, which is amazing. And safe to say that even though you're investing a small amount, a lot of money can be made if you're investing into the right things. And of course, there are also many other metrics that you can look at to make sure you're making the right decisions. These just happen to be my favorites so far. And on top of that, there are many other different dividend stocks and ETFs that you can invest into that can also make your small money a lot of money in the long term. And if there are any you're interested in me talking about, make sure you leave a comment below. But I appreciate you guys watching as always. And until next time, take care.